Inflation hits a new high in December with a year-over-year increase of 7%, which reaffirms Jerome Powell's case for rate hikes in 2022. But it's not the supply shortage, which is the item that's worrying him the most about the persistence of inflation. And this environment is not playing nice with Cathie Wood's portfolio. That's what we're going to be digging into in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. It's of no surprise to us that the year-over-year inflation rate in December hit 7%, which is terrifying. But as a little bit of a reprieve, one item that you guys may not be hearing about in the headlines, on a monthly basis, the CPI increased a seasonally adjusted 0.5% in December from November. So it actually decelerated from October and November. That's a little bit of good news there. Now, of course, inflation continues to surge with COVID-related supply chain disruptions and a shortage of goods and materials, coupled with strong consumer demand, are causing prices to rise. Federal Chairman Jerome Powell, in a congressional testimony on Tuesday of this week, said that he was optimistic that supply chain issues would ease in 2022 and help bring inflation down. But where have I heard that before? One thing that he said, which was a bit unnerving and a lot of people missed, was that he noted that a smaller US labor force could be an issue going forward. But what exactly is he talking about? Because the unemployment rate is really low. And from here, you can see that the 12-month participation rate is actually up year over year to approximately 62%. Well, that's not the full picture, because if you take a step back and see the bigger picture, you'll notice that the labor force participation rate actually declined 1.5 percentage points from the beginning of the pandemic and has not returned despite vaccines being available. And it might be early to make that comparison as Omicron continues to rage. However, this continues a larger trend of the participation rate declining in the US, with employment participation peaking in the early 2000s, and it's just been declining ever since. The housing crisis and the COVID pandemic just pushed forward an already materializing trend. So when Jerome Powell says that a smaller US labor force can be a bigger issue for inflation than supply chain issues, think about what he's saying for a second. And to understand that, you really have to understand the relationship between unemployment and inflation. And of course, guys, I got a smooth brain, so without complicating it, I'll just say that when unemployment is high, the number of people looking for work significantly exceeds the number of jobs available. So this causes employers to have no need to increase wages and attract qualified workers, as people rather have a job than nothing at all, especially if those people have family obligations such as paying the mortgage or just putting food on the table. In the current market, where the participation rate has materially declined, the opposite is true, where the demand for laborers by employer exceeds the supply. This is referred to as a tight labor market or a job seekers market. So good news for us, as employers typically need to pay higher wages to attract employees, which is what ultimately leads to rising wage inflation. But this can't be all good news, because those same employers have to pay for those higher wages somehow. First, they will typically start with cost cutting, and their staff may be given greater responsibility than they previously have had. But eventually, those employers will have to raise prices, thus causing higher inflation overall. So needless to say, in order to combat that level of inflation, it looks like rate hikes are on the horizon. But I'm not so sure how much the economy can handle. I would urge the Fed to act slowly, which of course they will do. I wanted to dig a little bit more into that inflation figure just to give you guys a little bit more information than you may be reading online. So first, you can see that a big portion of the inflationary increase was energy prices, which are up close to 30% year over year. And digging further into that, you can see that gasoline is up almost 60%. And this isn't anything that you don't already know, but what I wanted to point out is that if you have a longer commute, when things open back up, you're going to be paying much more to get to work. So for you, your inflation basket will be different than the overall basket of 7% that they're calculating. Your inflation basket might actually be 14-15% overall. So just keep that in mind. And of course, that gives us a strong argument for a hybrid type work environment. Additionally, digging into the food category, you can see that meats, poultry, fish, and egg prices are all up double digits at 12.5%. So for those of you that are on keto, this is your sign from the universe to knock it off and join the rest of us fatties stuffing our faces with potato chips, okay? And I'm sure you've heard this already, but the used car market really took off, and it's up 37% year over year. Cathie Woods was saying in her call on Friday that she is starting to see evidence of this subsiding. I don't see it yet, but I'll keep an eye out for it. Even new vehicles are getting pricier, as they're up 12% year over year. So it's probably better to just hold on to your clunker for now. So with rate hikes on the horizon, it's clear that some stocks will just be harder hit than others. Those with no earnings in emerging industries would of course be the hardest hit. Cathie Woods comes to mind, as she is very focused on disruptive technologies such as artificial intelligence, robotics, energy storage, genome technology, and the blockchain. And I don't actually dispute her conviction in these technologies, as I'm a huge believer in areas such as AI, energy storage, and cloud technologies. But I have a problem with the downside. And we hear Cathie Woods discuss a lot about the opportunities, and she never really discusses the valuations. I explained in my video on Zoom how high her expectations on Zoom's revenue growth needs to be to justify her valuation. It almost gives zero room for mistakes, which is something that I'm either too risk averse to understand or I'm just too unintelligent to understand the opportunity there. Overall, investors with high convictions in no earnings companies will likely continue to get crushed if the interest rate increases materialize, which I think they likely will, which is exactly why Cathie Wood's portfolios have hit 52-week lows this week. So I think more pain on the horizon for ARK's funds. Guys, if you haven't done so already, please consider subscribing to the channel. I do my absolute best to bring you non-hype, research-focused content, and with your subscription, YouTube really extends the reach of the channel, which allows us to help more and more people. Also, Cathie Woods said Zoom is a deep value stock. I'm not so sure, and so I did a complete analysis on it with a free-to-download model just for you, and you can check that video out right here.